Right, so Bitcoin's it's ripped from 60K to 65K in a single daily candle.
Wow.
The timeline's absolutely gassed. Everyone is screaming to the moon. So what's your move, Morgan? You smashing the buy button and FOMOing in like a proper rookie?
Absolutely not, Chris. I'm a CFA, remember? We don't chase. While you're, drawing lines on a chart, I'm looking at the real stuff, the funding rates, the open interest, the exchange outflows. I find the reason for the pump.
But-
I don't just react to a big green dildo on the screen.
Mate, that's exactly why you're always late to the party. By the time you've cross-referenced your third spreadsheet, the move's done and dusted. The chart gives you a smarter way in.
Okay.
It gives you a continuation pattern, and that is exactly what we're breaking down today. How to use these patterns to time your entry like a pro and, stop getting rinsed.
Continuation patterns. It still sounds like something you'd find in a kid's coloring book. Go on then, Mr. CMT, enlighten the rest of us who live in the real world. What are these magic shapes?
They're not magic, bruv. They're money, plain and simple. A continuation pattern is just a pause, a breather. The market's just had a massive sprint,
Right.
and it needs to chill for a second. Think of it like this. An F1 car screaming down the straight. That's your big price move, what we call the flagpole.
Okay.
Then it pulls into the pits. It's not reversing, it's not crashing.
Right.
It's just getting a quick tire change, a bit of fuel. That pit stop, that tight sideways chop, that is your pattern. It might be a flag, a pennant, a triangle, but it's your golden ticket to get in.
Right, the pit stop analogy. I like that. So you're saying instead of trying to leap onto the car at 200 miles an hour, you're looking to get in while it's stationary.
Yeah.
The risk reward is cleaner.
Exactly. You've got it. So let's talk about the most common one, the bull flag. After that massive pump, the flagpole, price starts to drift down and sideways inside a tight little channel.
Okay.
It looks like a flag hanging off a pole. That's the market breathing. Volume completely dries up. The early buyers are taking a little profit, but there's no aggressive sellers. No one's trying to nuke it.
Okay, so from my world, that translates to the macro narrative is still bullish. There's no bad news, no regulatory FUD, no reason for a full reversal. It's just organic profit-taking meeting dip buyers.
Exactly.
The equilibrium you see as a flag.
Precisely. So you wait. You don't buy in the middle of the choppy flag. You're patient. Your entry trigger is the moment price breaks decisively out of that top of that flag channel. And this is key.
Right.
It has to be on a big, beefy spike in volume. That's your confirmation. That's the car blasting out of the pit lane.
Right. And your escape hatch, your stop loss, I assume you're not just winging it.
Never. Clean and simple. Your stop loss goes just below the lowest low of the flag. Done. You have a calculated entry, a hard stop if you're wrong.
Okay.
Your risk is defined to the penny. No guesswork.
I have to admit, for all my roasting, that is a tidy setup. And curious, what about the upside? How do you set your target, or do you just post rocket emojis and pray?
We're traders, not a cult. It's called a measured move. You take the height of the initial flagpole, say it was a $5,000 move on Bitcoin.
Right.
You then project that same $5,000 distance up from the point where price broke out of the flag. It's a simple, high probability way to set a realistic first target.
A measured move. It's surprisingly quantitative for a technical analyst. I'm impressed. And curious, what about the other shapes in your coloring book? What are pennants?
Oh, pennants are the flag's angry little brother. Same idea, massive flagpole, then a pause. But instead of a rectangle, the consolidation is a tiny symmetrical triangle. Price gets squeezed from both sides tighter and tighter. It's like coiling a spring. The breakout is often even more violent.
So the tighter and shorter the consolidation, the more pent-up energy there is.
Yeah.
I see. The market hasn't had time to get bored. The momentum is still fresh.
You're getting it, mate. But what about when the market does get bored? When a coin just goes dead and trades sideways for weeks?
Now you're talking about a distribution or accumulation phase. That's my territory. On-chain volume profiles, whale wallet tracking.
Or you could just look at the chart and see a rectangle. It's just a big sideways box. Price is bouncing between a clear support level and a clear resistance level. A longer, uglier battle.
Right.
but the same rules apply. You can play the range, or you can wait for the breakout confirmed by volume.
And triangles, the ones that take forever to play out.
Yeah, the longer term ones. You get 3 flavors. First, the ascending triangle. You have a dead flat resistance level at the top, but the lows keep getting higher. It's like someone's knocking on a door harder and harder each time.
I see.
It tells you the bulls are getting impatient. It's building pressure for a breakout to the upside.
So a descending triangle is the opposite, a flat support level with sellers getting more aggressive, creating lower highs, leaning bearish.
You got it. And the symmetrical triangle, where both sides are converging to a point, is the most neutral. But 9 times out of 10, that spring uncoils in the direction of the original trend.
Dramatic?
But here's the real test, Morgan, the thing that separates the pros from the plebs. What about the fake out?
Ah, the false breakout. Price pokes its head out of the top, all your breakout bots fire, you jump in.
Yep.
And then it smacks right back down into the range and takes out your stop. Your tidy setup just rinsed you.
The ultimate pain. And that, my friend, is where you learn to read volume. A real breakout happens on a massive surge in volume.
Right.
It feels like the whole market is stepping in at once. If you see price creep out on a pathetic low volume candle, it's a trap, a liquidity grab. Stay out.
So volume is your truth serum. It validates the price action.
It's your bullshit detector. Low volume breakout? I'm not interested. In fact, I might even wait for the 4-hour or daily candle to actually close above the pattern before I enter. Let the impatient rookies get chopped up. We enter on confirmation.
Patience and confirmation. See, now you're speaking my language. It's not about being a wizard.
No.
It's about having a disciplined process for identifying and executing on high probability setups.
That's the whole game. This isn't about 100% win rate.
Right.
It's about finding setups where your risk is tiny compared to your potential reward. Continuation patterns serve that up on a silver platter. They are, without a doubt, the single best way to join a strong trend.
All right, I'm sold on the framework. It's a structured way to manage entry risk. I'm still going to check the on-chain data before I push the big red button.
You do you, mate. While you're deep in your Glassnode report, I'll be taking profit at target 1. Speaking of which, for everyone listening, if you want to see these patterns live on our charts as we spot them, you need to be in the Big Short Club chat group. The link's right down below. Get in there. It's where the real alpha is.
Yeah, join the group. You can get a front row seat to watch Chris draw his colorful shapes all day.
Oi, cheeky. Just get in the damn group. Sorted. Now, here's a question we'd like you to think about and maybe drop a comment below. If a continuation pattern represents a pause where bulls and bears reach a temporary truce, what single piece of data, be it technical or fundamental, do you look for as the ultimate tiebreaker to signal the trend will resume? Think on that. We'll see you in the chat.